Thank you very much, Adrian. So it's a pleasure to be here, and I always think that if you really want to electrify a crowd, you bring up a bunch of bankers. So, so as Adrian said, I'm with the International Finance Corporation, which is part of the World Bank Group. We are the sort of private sector lending arm of the World Bank. So we do commercial lending strictly to the private sector in emerging markets. So we've been around since 1956. Each year we finance around anywhere from 10 to 15 billion, both in debt and equity. And said that we basically behave like a commercial bank, but we have a development objective. We lend on commercial terms. We've been fairly active in certainly in the mining space for a very long time, primarily providing equity, but also some debt. We've in the renewable sector, which is where I spend most of my time, we've been very active, at least for the last 10 years. We've financed to date about 3,000 megawatts of wind in about 24 countries around the world. And we've also financed about 1,300 megawatts of solar in about 7 countries around the world. So mining is something that we're very comfortable with. Renewables is something that we're very comfortable with. One of the things that we have never done, or that we've done relatively little of, is financing renewables for mining. And it's an obvious point of intersection for us. Last year we actually financed a 100 megawatt solar installation in Chile, built by SunEdison, with the offtake to a mine. This is something that we'd like to see a lot more of, but you know, obviously it's quite a challenge, and it's interesting getting everybody together to sort of focus on this challenge. So I think over the past day and a half, I think there's really a few points that have come out to me that have been kind of crystal clear. The first one obviously is that dropping commodity prices is really pinching margins. I think Steve Letwin of I Am Gold yesterday was saying, when your gold's at 1,100 and your production's at 800, your $300 margin isn't very much. We also, I think the second point that we learned is that obviously power prices are very high. It's not unusual for mines to, certainly off-grid, to have power prices anywhere over 25, 30 cents a kilowatt hour. I think John from Roxgold was mentioning that it's about 30 to 40% of their OPEX. The third thing that's pretty apparent is that renewables can present an interesting, compelling cost solution as long as it's given a long enough time. In IFC, in our portfolio, we're regularly financing renewables projects, wind and solar, at anywhere from 8 to 15 cents a kilowatt hour. But the big rub, and the elephant in the room, is this issue of the tenor of the agreement. It's got to be a 15 to 20 year offtake for us to be able to get down to those prices. But obviously, that's a pretty tough length of time to get to for a mine. It's saying 8 years, 10 years, maybe. Anything over that is really difficult. So what it really comes down to when you put all this on the table is who's going to pay for it and who's going to take the risk. And ultimately, it's these people. You're going to find yourselves in front of a bank trying to justify this project and trying to get financing for it. So it's a real pleasure for me to bring together this panel who have experience both in financing on the mining side and on the power side to provide their insights, because at the end of the day, if you've got a great project and you're a mine or you're an independent power producer and you go to the bank, you want to know how they're going to look at your deal and how they're going to consider who takes the risk and ultimately whether or not you're going to get your financing. I think that, and Liesl, I think yesterday also said that it was, in the end it comes down to people. And these are some of the people that you would be meeting with and that you have to convince. So what I'm going to do is we'll kind of go around and get each of them to introduce themselves and maybe just talk a little bit about yourself, and particularly what what your work has been in either renewables or mining, or a bit of both. So, hey, Richard, let me start with you.
Sure. Thank you, Sean. My name is Rick Reeves, and I'm I head up the mining project finance business for MUFG in the Americas, which is North and South America. We, as some of you know, we used to do business in the Americas as either BTMU Canada or Union Bank, and the MUFG is the merged name. And it's also now our global brand. But at any event, we are the #1 project finance bank in the Americas, and it's fair to say the lion's share of our business is actually power. So we do finance power plant projects across all the different technologies, both fossil fueled and renewable. With the only thing that's kind of rare, and it's mainly just because the economics of it are so difficult, would be the nukes, and also the level of coal-fired financings are way off, just because of the fact that coal is currently the price of natural gas in North America has essentially displaced coal out of the market almost completely for new build. That said, we do a lot of renewables. We do both wind and solar. We do it throughout the Americas, and we have done some renewables that are attached to mines, with one of the more recent ones being the one that was attached to Antofagasta's Los Pelambres mine down in Chile, which is, in some respects, that's a good, it's a bit of a good example, because it does show that the underlying risk of financing a renewable facility that is dedicated or captive to a mine is really, in fact, the mine. Because at the end of the day, the cash flow that goes to that power plant is entirely from the mine. And so therefore, the fortunes of the power plant and the fortunes of the mine are inextricably linked. And and for example, when Los Pelambres was shut down for a few months, well, basically there was no power being drawn, and that really knocked the cash flow of the renewable facility off. And so it does get to what Sean is talking about, the issues of tenor and the issues of how do you deal with the fact that the fortunes are linked. And I think it's fair to say we tend to look at these as joint power/mining deals internally, because of the fact that we know that the risk is tied to that of the off-taker. But the one thing I would say that I think that when people talk about the tenor of these agreements, and this is something I would throw out to a lot of people, is, the fact of the matter is when you're looking at the tenor of a solar deal or a tenor of a wind deal, if you're competing against grid-based fossil fuel plants, obviously, even with subsidies, you have to have a lower cost basis than maybe you might have to have if you have a captive mine customer. Because your captive mine customer, their alternative is basically to use diesel. So their actual price, as Sean has mentioned, is 30 cents per kilowatt hour. It's not like 7 or 8 like it would be down on the grid in the Midwestern U.S. And so it's a very, very different situation from the standpoint of where do you really need to be. And by way of background, by the way, just I've been in the project finance space now for about, I guess, nearly 20 years, 21 years actually. And I came to that after I got a degree in business, and prior to that I was a mining engineer, and I spent about 10 years in the mining industry. So I sort of cross over both, which helps a little bit. 35 years out of the Colorado School of Mines? Yeah, that's a frightening thought, but it has been that many years.
Tom, tell us a bit about yourself and your work in both mining and power.
Sure. So I am a partner and general counsel of Coronal Group, which is part of the financing arm of Panasonic. We have been in partnership with Panasonic for a number of years and focused to date a lot on solar power. But that's broadened significantly in recent years to focus on storage solutions and things of that sort, which we know are particularly important on the mining side. In terms of background of our company, we have over 100 megawatts of solar facilities that are operating in the United States and a project here in Canada. We have several hundred additional megawatts that are either in construction or contracted and about to begin construction. Most of that also is in the United States. In terms of my background, before I was at Coronal and Panasonic, I was at an outside law firm, Milbank Tweed, which actually was the lender's counsel on the Los Palumbres mine financing. So I'm actually very familiar with that financing, which was put together in 2012, and I guess it came online in about a year ago in 2014, and is one of the largest renewable projects in Latin America. But so I agree with Richard that that's a tremendous case study for everyone, both on the PPA side and the finance side. But in terms of our focus and our interest in the mining space, I do think it's a very fascinating opportunity for folks from kind of different backgrounds to come together. And I think the key starting point is kind of a sense of collaboration, and we've begun that already in the United States. In particular, our largest operating solar facility, which was commissioned by Panasonic in December of 2014, is a 35 megawatt facility that's located on mining land that is owned by Asarco, part of the of Grupo Mexico. And we had quite an interesting experience collaborating with Asarco from a public relations perspective, working with the utility, working with them on the land. And it really was eye-opening, both for us and I think also for Asarco itself, who apparently has been involved rather extensively in using green energy to not only satisfy certain energy needs. They have some wind projects, for example, in Mexico, but also to basically have an opportunity to participate on more of an environmentally friendly basis and improve relations with the local community. At that facility, there's actually there's a Discovery Science Center, which explains the science behind solar power juxtaposed with the science behind mines. And it's a really fascinating little tour, and that facility itself is actually powered by a small solar plant that satisfies 100% of the facility's needs. We're currently building a second phase of this project, another 20 megawatts. Now the offtake is a utility, but again, it's a mining land project, and it's been a good starting point for us. We look forward to expanding beyond to working with power plants where a mine is the offtake.
Right. Great. Andrew?
Hi there. I'm Andrew Lynn, and I'm the Managing Director and Head of Project Finance at DBRS. And DBRS is the fourth largest rating agency in the world, headquartered in Toronto, but with offices in New York, London, and Chicago. So within Project Finance, we rate projects on a non-recourse bankruptcy remote SPV, which is independent from the off-taker or from its owner. And we have several different projects in the renewable space covering hydro, wind, and solar. We also have a mining group, and there we rate some of the largest mining companies in the world, like Barrick, BHP, Potash, Alcoa, Teck, and Sherritt. But curiously enough, we don't actually rate any projects or renewable power projects or power projects independently of the mines, where the mines are the off-taker. And actually, when Adrian first called me to ask me if I wanted to speak here, I asked her, are you sure you actually want me to speak there? Because I'm going to put a little bit of a damper on the conversation. Because There are several different reasons why this hasn't been seen. Very few examples of it done on a non-recourse basis away from the mine itself, and I guess we're going to be talking a lot about that today.
Thanks. All right. Well, maybe Richard, we can start off with you. I mean, the first question is, I would say, an IPP walks into a room, which is kind of a start to an interesting joke. But let's say that an IPP walks into your room and they say, look, we've been working with a particular mine. It's either an on-grid or off-grid mine. We're looking at at a power purchase agreement for 8 to 10 years. And we're seeking financing for it. So let's say we need 50 million capex, and they're looking for you to help them. How are you going to process that deal? I mean, how are you going to look at it, and what are kind of the weak links that you would look for in the chain, and what are the characteristics of that being a good project, and conversely, what are the characteristics of it being a bad project? So what are the most important parts of that project and the biggest questions that you're going to ask when that person comes into the room?
Okay, I think that this is, the first thing that you said it's either on-grid or off-grid. And honestly, the answer to that question is very important. And the reason is because if the power station is on-grid, or going to be on a grid, where there's actually the need for its kilowatt hours, okay, that's actually probably really adds to its financeability, because at that point in time you can then say, okay, well, the power station or the power production facility, or whatever we want to call it, is sure its initial and primary customer would be the mine, but you also can look at, well, what does it look like if the mine's not there? And and then I can see two ways that I would sort of look to approach that creatively. If the grid and the off-taker that ran the grid, if the company running the grid was creditworthy, you might say, well, you know what? Maybe what you try to do is you try to get the mine as a co-investor in this thing, but you basically actually sell the power to the utility and buy it back from the utility into the mine, and that puts the credit risk back over to the utility. That's a way of maybe structuring this thing. And so, and the reason that matters is because you then are starting to look at, well, who's a more desirable counterparty from a risk perspective, and also who has a longer capability of tenor. Because whenever we deal with a mine as a risk counterparty, we have to remember that the tenor of the loan starts with the reserve life of the mine. And typically, a commercial bank in project finance will not lend money to mines for a tenor exceeding the lesser of 2/3 of their reserve life.
So what you're saying is that if somebody walks in and they say, I've got a 15-year or 20-year PPA, then effectively you're going to discount that and say, well, that's great, but
if you have a 20-year PPA
years.
with a mine that has a 15-year mine life, we're probably going to start at 10 years. Yeah. Because at the end of the day, we don't want to take that reserve risk on the mine. And you might say, well, why don't you lend to the life of the mine? Well, the fact of the matter is, what we're living through right now is the answer to that. The minerals industry is cyclical. The commodities business is cyclical. I'm actually not quite 35 years out of the School of Mines. I'm only 33. But any event, well, I mean, give me those 2 years, man. So, any event, when I graduated from the Colorado School of Mines, we were in a far worse commodity price environment than we are now, quite honestly. The price of copper was it was ridiculously low at like 60 cents a pound. The price of coal was plummeting because of the fact that basically the Japanese steel industry had managed to start to displace the old open hearth businesses in the States. And so the price of met coal was dragging the price of thermal coals down. The price of gold was sort of all over the map because of everything going on with what the Fed was doing at the time. And you know, I actually quit going to SME meetings when I first got out of the School of Mines because every time I went there, everybody there kept asking me for a job that I couldn't possibly give them. And it just got too much. And you know, and so this happens, and then it ramped back up, and it cycles, and then it ramped back down, and it's kind of like when you know you're at the top of a cycle. It's like the old joke where, you know, somebody says, I knew the market was about to crash in 1929 when all the bellboys and cab drivers started giving me stock tips. And it's the same thing, you know, about the time that, you know, all the grandmothers and people that are, you know, you would never see in the market are going out there saying they got to buy gold coins. You know, that's probably a bad sign. But my point is that it is cyclical. And so we want to see that extra reserve life because of the fact that we know that if we hit a bottom end of the cycle, we may well have to restructure the debt. And that's actually something we're planning on. And so that said, that's why we truncate there. Now, sometimes banks will maybe go 12 years. Maybe we can get ECAs in it to go up to 14. But you know, going 20 years, at the end of the day, the PPA is only as good as its underlying asset.
Andrew, what would you say? I mean, the same kind of situation, do you think? What other risks are there? I mean, obviously, the offtake risk is a big one. I mean, what else are you looking at?
And certainly we take a look at a lot of the same risks. And one thing to keep in mind from a rate agency point of view compared to a lender is that we rate everything probably from super at AA, AAA, all the way down to just before bankruptcy. So there's a whole range of ratings that we can provide that are either financeable in the bank or bond markets or have very few takers, but we can still rate them. And I think what a lot of people care about then is trying to get into an efficient rate-in where the cost of capital is efficient. And that's typically what we call our investment grade at the BBB range and above. Unfortunately, a lot of mining companies are not even investment grade. So then you start getting into the non-investment grade ratings or the high yield bond market, and there's still a market for that, but it's obviously a lot smaller. But when you take a look at the risks, then the same sort of risk in terms of the PPA term versus the term of the bond fully amortizing, that's an important factor. That said, if you don't have the bond totally refinanced during that PPA period, then we start to do more merchant type analysis, and we figure out, well, what are the other options at that point, and being connected to a grid and seeing if there is a market that it can feed into, I think gives us a little bit more comfort. Now, typically though, that doesn't quite meet that investment grade rating, but again, there is a market for non-investment grade. One of the other risks, though, is in terms of resource risk. So whether it's hydro, wind, or solar, typically you're looking at resource consultants. They may be right, they may be wrong. Sometimes they have a lot of historical data. So for instance, hydro, typically some of them have up to 100 years worth of data. So pretty good. Other ones where it's more of a measurement instrument like wind or solar, you have to take a look at these things with a bit of a jaundiced eye. Another area that we look at is O&M costs. So, for instance, these costs, a lot of them get back-ended, especially with wind in the back years. And when you do your financial modeling and stress testing these 20, 30-year models, you have to err on the conservative side. Conversely, on the hydro side of things, as long as you keep the turbines in a good shape, these facilities can be almost perpetual assets. So there's different plus and minuses in terms of O&M costs, but that in addition to the renewable resource are things that we take a look at. One of the things that we do note, though, is that even if there's a good coverage ratio, so a good DSCR on the actual project itself, if the counterparty who's paying that is not very good, so if it's a single B or a double B credit, then that acts as a cap. It acts as a cap to our credit rating that we would assign to the entire project.
So the chain only being as strong as the weakest
The
link.
weakest link,
Yeah.
yes.
I mean, I think that it's interesting. So, you're talking about the strength of the off-taker, talking about the sponsor. I know that in IFC, when we were looking to finance a project, certainly on the renewable space, we spend a lot of time getting comfortable with the sponsor, and we don't like, sponsors that take shortcuts, and part of that is just, spending the time that's necessary to do a good assessment. And if you have somebody, I think, that comes in and says, I've just done a desktop assessment, here's my spreadsheet, that doesn't count for much. But if you've got, they've gone out and spent the time to get good data, they've got good analysis from folks with experience in the field, and they've built facilities like this, then that provides tremendous comfort. So it's offtake, it's sponsor. I mean, Tom, what would you say is another other elements that you would look for? Again, an IPP's in the room, they're looking for you to provide them with financing. It'd be interesting also to hear your perspective on securities, that you would be seeking if there are shortfalls, if there's concerns that you have, excessive risks either on the off-taker, on the sponsor. What kind of securities would you seek that would give you comfort, that would allow that financing to be at a reasonable rate?
Sure. I mean, I think the thing to keep in mind, in this scenario, point number one, a 10-year mine life. I mean, that is going to be challenging to finance using a classic project finance model. So that's kind of right out of the gate. But you need to sort of put yourself into the mind of the banks that are the participants in this sector. Banks have a strong affinity for utilities as just part of the core infrastructure of whatever territory that the power plant is going to be in. But once you move out of that comfort zone, standard metrics that you would see in your debt financing are going to change. You see this in the United States on the distributed generation side, where a lot of folks have pursued solar or other projects in the renewable space that maybe the offtake is a retailer or something like that. Banks are not going to view a retailer the same way that they would view a utility, maybe not even a mine. But I think Richard really highlighted the key factors. If you can get a utility offtake, well then you're talking. If you don't have a utility offtake, ideally, if you do have one of the few investment grade rated mining companies, and I know some of them are just barely hanging in there, then that's the next best thing. And beyond that, if you're really looking at just kind of the mine itself, then yeah, you're going to basically be looking at shorter amortization periods relative to what you would get in a utility scenario. You're going to get higher reserve requirements. Probably postings of letters of credit, above and beyond what you normally would do. You would have major maintenance reserves, all of those factors, but it's just going to basically be taking your utility model and making it that much more or less attractive in order to basically give the bank the comfort that they need. Now, in our group, we're kind of a hybrid in the sense that we're both on the borrower side and we're also on the financing side. So one of the benefits that Panasonic provides on our platform is in the classic project financing model, usually you start off with construction loan, which, assuming you're using the same set of banks, you then term convert that into the longer term project finance loan. We're a little bit different in the sense that we work with Panasonic, and Panasonic internally on its balance sheet provides the construction financing. So at least it takes a piece of that out of the way and maybe buys you a little bit of time to work with the mining company or whatnot to think about how best to structure this in the long term. But that's really the challenge of the day. And I think in terms of going beyond, I think Richard's got it right, honestly. I mean, the mine life needs to be X number of years. You have to discount that a bit. In terms, if you compare that to just financing and amortization periods based on the PPAs themselves, so normally if you have like a 20-year utility PPA, you're probably dealing with a 17 or 18-year amortization period. With the competitiveness of the financing industry the past year, there have been banks and borrowers who've sort of been pushing those limits a little bit. You could possibly borrow from some of the techniques that are being used to extend those amortization periods maybe to the full PPA term. In some cases, as Andrew was saying, even beyond that, based on a view toward merchant risk. And there are techniques such as cash flow sweeps, guarantees, things like that that can be provided to possibly get the banks comfortable. But this is very much kind of a pioneering effort, I would say, right now between banks and borrowers, and even more so in this space.
I mean, it does come back to this whole point of the on-grid and off-grid, and I mean, so that's absolutely the first question, because obviously, if it's, I know for the project we financed in Chile, it was, we had mining risk, but in the end, if CAP in that case, if we had issues with them, then we'd fall back to a merchant grid, or to the spot price on the grid, which certainly at the time was great. It's come down a bit since. But yeah, that provides a lot of comfort. But so what do you do then? So okay, let's say the IPP has come in. They've said we've got this, it's a 12-year PPA with a mine, but it is off grid. We've got equipment life of 20 years, so we know that even if something goes wrong, we can still do something with this equipment. But they're not on grid. They might be on grid at some point, and I know in a lot of places where IFC works. Sub-Saharan Africa, there's promises of the grid extending out, and eventually it will be connected in 5 years. But how do you look at that? I mean, like, what mechanisms are you looking at? Like, are you just going to say, listen, this worst case scenario, 10 years, your off-taker's gone, forget it. I will not put anything in my spreadsheet to assume a value at the end. So how do you get around that? And I know a lot of mines have talked about it as an asset that they can hold to the end, and they can be part of the end of mine assets that are, I guess, part of a bond in effect. I mean, how would you look at that?
Well, I think it very much depends on where this mine is located. So in the United States, you've got the benefit of PURPA regulations, which basically say that if there's a QF, a qualifying facility, then there's going to be a market for the power. There's a requirement. So if I haven't done a survey of other emerging market countries, but obviously if you had a situation where the mine can be the offtake for X number of years, and then there's a requirement by statute or regulation in a country that's a credible country to take that power and sell it to the grid, that could at least give you something. But I'm not sure how much right now, banks would, I guess we can ask Richard, but how much, that would ultimately, benefit things. I think in terms of, I would try to emphasize to the mining operator, are the reserves expandable? Is there a way that, maybe you could make some contingencies that if the reserve life increased, that maybe there's a way to, have a PPA that's extendable, which could trigger additional financing, something like that. Might be an interesting way to look at it. I haven't seen that done, but would be worth, trying to figure out.
Richard, you've got the benefit of experience also working in North America and South America as well, where the regimes are a little bit different. I mean, how would you deal with this risk?
Well, I think that one thing that Tom has raised, and this is it's important, maybe going back to front for a moment. First of all, the idea that I think the IPP operator needs to realize that their fortunes are really tied to the mine operator. So it's extremely important to start talking to the mine operator early on. And if you have a 20-year PPA opposite a mine that has, say, a 10-year reserve life, but say the mine at the same time has that 10 years of PP reserves is backed by another 20 years of resource, a lot of times the difference between reserves and resources is mainly an engineering study. And so perhaps a thing that the mine needs to do in order to take advantage of the ability to have the renewable facility is they may need to prove up more reserves. Now, it may be difficult for the lenders to go that far. They might not be able to do all 20 years just because, again, we're looking at it as the mining side, but at least you can maybe get yourself out to 12. Might even be able, if you can get agencies involved, you might be able to get some 14-year money in it, and that can really help. I think that, and the other thing is, and that you have to do is, is, as was mentioned, you really have to have these studies done for the diligence on the resource that you're going to exploit as a renewable operator. You know, that's really important, and because, you know, that becomes key. And you know, I think that, you know, you have to realize those studies have to be realistic. You know, banks have had a few of these come through where they've found out that the study was maybe not quite as you know, realistic as it should have been, and it kind of overpromised the amount of resource available. And renewable resources are always a little bit how do I say, they're not a resource that's like a known resource. It's really what's available is available on a probability-based curve, and even more so for wind and solar than for hydro, because of the fact that at least hydro generally has a storage capacity built into it, and so that those studies really are key as well.
So, I guess it's safe to say that that IPP that walks into the room to talk to you looking for financing, if they come in with the mine, if it's an off-grid mine, then obviously if they come in with the mine and essentially say this is a joint project, then that probably alone provides you with some comfort, right?
Well, absolutely. Even if at the end of the day, if the obligor is the IPP only, and say the mine doesn't guarantee the facility, which it probably won't. But at the end of the day, you still have to get comfortable with that mine, because you know, a typical deal like this, you'll end up taking security over the IPP, you'll take security over the power purchase agreement, and you know, you're probably not going to be able to reach back into the mine. But at the end of the day, you know, you still need to get very comfortable with the fact that the mine can make that, it can live up to its obligations under the PPA.
Yeah, I think it raises another, you know, important point for the IPP in this scenario. I mean, we've seen this even outside of the mining context, but not only the strength of the, I guess the engineer and geological reports on the mine reserves themselves, and the reliability and historic reliability of that, but the getting an independent engineer that the banks so heavily rely on, in some cases maybe even a couple of them, but getting an independent engineer report done in advance, so it's not just kind of an early draft, and working with an IE firm that has experience in the area. We've encountered so many cases where for on-grid systems, well, it could be an area where the grid is unstable, so the availability of the power plant is lower than modeled, and you might have perfectly good engineers, you know, writing up a perfectly good set of resource estimates for the facility, but in practice it may not work out that way. And then similarly for off-grid, and particularly for mines, you know, what if there's not very good dust control and you have a solar plant? That has a huge effect on the output and production, and that can scare the banks away. We had a project in California which is going or had been going through one of the worst droughts in 100 years, and it just so happens that there was a cement plant a few miles away that no one really paid attention to. The dust clouds from that cement plant were literally stacking up cakes of dust on top of the solar panels. So we're having to wash. We had built into the model washings about twice a year, and we're doing it monthly, just to control that factor. But that's a real cost, and so I would strongly recommend you know, focusing on an experienced IE that knows the particular area of the mine.
I know from our perspective, if you walk in with one of the first things we'll look for at IFC is a good engineering study done by a Hatch or a, you know, Fichtner or DNBGL, et cetera. But a lot of times we'll look at that and say we'll do our own assessment, and we'll hire our own IE to do an assessment on that other assessment. I mean, the level of caution in these investments is huge, and frankly, from the perspective of renewables, it's been borne out in practice. I mean, if we look at our portfolio, it's been known that, you know, that there's been issues with IE's projections on performance. Even the best in the business have projected performance. But I mean, Andrew, the other question obviously is like, okay, so the IPPs there, they say, okay, we're looking at some mechanisms whereby we can deal with the end of, going past 10 or 12 years. The issue of, the price is a big one, and obviously with the fluctuations in commodity and fuel prices is a big question, and Manuel from Voltic was, I thought, presented a really interesting structure to deal with that variability and that, like, how to manage that. So again, you're as a bond issuer, as a ratings, as a ratings agency that leads to bonds. I mean, how would you perceive that? I mean, if somebody comes in with one of these cool price mechanisms that appears to hedge that risk, do you look on it favorably?
I think that's great for the mines. As far as the lenders go, you're really passing on that risk over to the lenders. The lenders really essentially want nice, steady cash flows and the certainty of those cash flows. And obviously, after a PPA period, you've got that volatility. And if there was a way to look beyond that, and this goes into the merchant analysis or what have you, if you knew that the mines was going to continue to operate at a certain volume because you've put in the capex there to ensure the long-term life of the mines, and you had someone in terms of the mines off-taker to buy that product at a certain price, then you've got the revenue stream at a certain level. If you don't have that, and I think what was proposed before was essentially having the PPA price for power indexed or matched with the commodity prices. Well, then you start introducing volatility and variability into the coverage ratios. So again, that's great because for the mines, they're more hedged, but frankly, that puts on more pressure onto the lenders, and therefore that would affect the credit rating. So I don't think there's a free lunch there. It's someone's got to take that risk, and the lenders will always want to push back on that.
Well, maybe I was thinking, imagine you've got a few questions and stuff. I'm not sure if there's a microphone circulating. Maybe today I think we've got about 10 minutes for questions, so we'll do that. We've got one. Does anyone else find this orange box hilarious?
Hello. That's pretty fun. Hi, Ian Weir from RPA, or mining consultant firm. I'm looking, what kind of value is put on a solar asset after 10 years? Like if the mine were to shut down in 10 years on a 20-year agreement, like what kind of value put on that? Can those panels be resold? Can they be repurposed? How's that taken into consideration?
Yeah, I mean, it's a good question. I mean, and again, in that spreadsheet, are you at 10 years? Are you just assuming zero value for the equipment? I mean,
I can take
Andrew?
a shot at that. If you take a look at the panel degradation, they're probably degrading at a rate of about 0.5 to 1% per year. So that's the power output. So if you take that down to its power capacity in 10 years, and let's say it has a 20-year life, and I'm sure that's probably about half the power that it can produce. Inverter lives 7 to 10 years, and so you're probably at the end of the life there. So there probably is some residual salvage value there. Then you have to minus the cost of actually taking it apart and delivery costs. And if it's at a remote location, transportation costs could be significant. So those are all the costs that you would calculate in to figure out what would be the residual salvage value out of those particular assets. There would be some value, certainly a lot more than, say, wind, where the fact that it's hard to remove and decamp, and it's everything's relative. That probably has a little bit more value than other forms of renewable generation.
And I guess sort of related to that, I mean, I think the question was brought up earlier about, like, if it's a mine that says, listen, we're going to invest in this 10 megawatt plant, it's over. We're going to finance it on our own, but we're also going to assume that if things, we're going to do it on a 10-year basis. But if things go really wrong, then this 10 megawatt plant becomes part of our end of mine obligations. Does that, Richard? Does that hold well? I mean, we say like that's it, and rather than putting a bond down for the life of the mine to deal with the end of life, this is going to be an asset that is going to be turned over at the end to the community, or will it be an asset that feeds into the grid? I mean, does that hold water?
I mean, it definitely helps if it's an asset that can feed into a grid. I mean, it depends on where this thing is. But if it's an asset that can feed into the grid, then it's probably an asset that'll just continue as an ongoing entity. And so what you'll really have is you'll have sort of a hybrid deal that will be a PPA to a merchant. And, and then and now banks tend to, and I mean, our bank, we actually, we do both PPA-based and merchant deals. But, merchant deals are under a different set of credit criteria, just because of the fact that you then have introduced merchant risk. But that said, if it's on a grid, that's probably the best way to go. If it's not on a grid, then it depends on who or what's going to be up there after the mine's gone. If it's like one of these diamond mines that's up in, past the Arctic Circle, I'm not sure who's going to be up there to buy the power. I mean, it's a kind of, the only reason you live up there is to mine the diamonds. And so the whole point is that's, if anything, it probably adds to the overall reclamation load, because you're going to have to dismantle it and usually and ship it back out, and as it's just, at the end of the day, the question is what is it really worth after you've managed to ship it?
Any other questions from
Sean.
Oh, sorry. Yeah, go ahead.
Yeah,
Andrew,
I just
answer the
wanna-
question, then bring the orange box over.
I did want to leave things more on a high note. That there's one example I can give out there, which is Tech Resources has a power plant called the Waneta Dam power plant out in BC, and it had built that facility. Granted, it's hydro as opposed to wind and solar. The good thing is it is actually on grid, but they built it and then they sold part of that to BC Hydro. So it is essentially project finance, and the main off-taker is Teck itself for its mines. But again, because it is actually on grid, beyond that PPA period, BC Hydro as the part owner was sufficiently comforted that it could actually take that power thereafter and feed it into its own grid. So there's an example of something that actually does work, but it doesn't face a lot of the issues that perhaps the mining industry does face.
Right.
Yeah, hi, Margot Le Guen from Renewable IPP. What kind of guarantee would you be looking for those projects? I mean, mining companies usually do not provide parent guarantee for these type of projects. And Richard, you mentioned that, if it's connected to the grid with the utility, I mean, in sub-Saharan Africa, the utility is not that much better than the mining company. So, for example, for projects in Africa, what kind of guarantee would you be expecting? Thank you.
Well, first of all, I need to preface this in that I actually am only responsible for the Americas for the bank. So I don't do a whole lot of business in Africa. But I think that said, if the operation was located in a country we considered to be politically risky, we would probably actually look to get political risk insurance on it from somebody like Sean's organization and the other ECAs out there. But the other thing is in a lot of cases, frankly, frankly, the mine's probably a better risk than oftentimes those kind of grid operators in those countries. And so, the question is would we look? We probably wouldn't get a guarantee from the mine on the deal, but we would probably look for at least some kind of completion coverage from the sponsor. We would certainly look for the mine to sign into the PPA, and we would take security over that. We'd look for political risk insurance on it. And now a lot of times in the power industry, completion risk is often a little more liberally covered than it is in the mining industry, in that usually the banks will agree to do an LC to cover that completion risk. And that's something that we don't tend to do for the mining companies. And that's because of the fact that the mining industry has a lot more unknowns that feed into its into completion risk, because unlike a power plant, you know, the mining industry is actually dealing with a lot of geologic issues that you don't see in power. So I think those would be the way we would try to cover that off. And particularly on a solar plant or a wind plant, the fact that, you know, most of the machinery for it will have to be imported into the country. You know, those are great deals to start taking to the various ECAs as well, depending on how large it is, including you.
And I guess there's often the question about the guarantee that's needed from the mine itself. I know there's some entities that will seek a parent company guarantee, which is just not forthcoming, or I think it's a fairly rare thing, right? I mean, is that an issue if they come back and they say, listen, you've got recourse? Like the mine says, look, okay, we'll provide some degree of warranty, but the parent company absolutely not. That's a firewall. I mean, is that will that kill a deal, or is that?
Well, the thing is it really depends if the mine's up and running, and this is you know, a big piece of it. The question is in a case like that, who's really the most appropriate developer of this asset, of the renewable asset? Should it be developed by an independent producer who's completely separated arm's length from the mine? Or should maybe the mine itself simply develop the asset? Or maybe, and the independent producer come into the same ownership structure as the mine, or maybe they're not owned by the mining company, but becomes a JV.
So what's that threshold? I mean, what would you consider to be the threshold at which you just say, so it's the mine that comes into the room now, they're seeking financing, or they're seeking a rating to be able to raise a bond to construct a large solar plant or a wind farm. At what point do you just say, look, you know, rather than doing kind of a non-recourse project financing or just having it's an entity on its own, would you just say, look, just do this as a balance sheet finance? Do it on your own because you just, I don't know. Tom, do you have?
Well, I mean, you know, my view on this, we encounter this not infrequently in. Is this working still?
Here, try this
Yeah.
one. Battery may have gone.
Yeah, I think the battery died. We've encountered this in a number of you know, island countries and other jurisdictions. I mean, it's a good question. I mean, naturally, as the IPP, you're always going to seek the parent guarantee, right? And if you're the mining company itself, you know, it's probably not a bad idea if you started with maybe a pilot project and did do that on a balance sheet finance basis. It's not that huge of a capital expenditure to do a few megawatts, demonstrate that you're able to operate this, you know, safely and reliably for a certain period of time. That can give the banks comfort, but you know, my suggestion here, what we've done in a lot of cases is try to find maybe a different entity within. Maybe it's not the highest level parent. Maybe it's a regional entity that owns this mine and a couple of other, you know, mines in the area, especially if they're operating, as Richard said, and that. Sometimes that can be a little more stomachable than the alternative. And then the other type of guarantee that banks may also look at in this case would be from either the O&M provider or in the outset the EPC provider, but the production guarantee, and that's yet another you know, can of worms. On the Panasonic actually provides that for us on a long-term basis, and that's extremely helpful to securing debt financing. But you know, that along with tier 1 equipment with you know, warranties that might actually be, you know, honored would further fill in the gaps in the financeability.
Right. I think. So yeah, I think we got time for. Let me just check. We got time for one more question there. Okay, so maybe Andrew, go ahead and we'll bring the ubiquitous orange box over to the gentleman here.
I was going to say that I think it really depends on what the cost of capital is, whether it's on balance sheet or whether it's done off project finance. And in most cases, the projects, if the main off-taker and the only off-taker is going to be the mines, then you're not going to get a credit rating or a credit risk that's much different than the mine itself. In those cases, for all that extra work, you're probably not going to get you're not going to get a cheaper financing, so it's better to do it on balance sheet. In the example that I'd use about tech and a couple other ones where you have more diversity of potential off-takers, you have some backup plants, you can actually potentially get, for that particular power project, a higher credit rating and a better credit risk than the mine itself, and that's when you get a cheaper cost of capital, and that's when it's really worth it to do off-balance sheet.
A question? So is it, yeah, not sure where the microphone is.
Thank you. Very informative presentation so far. And I'll go back to the social license concept and discussion that I raised this morning. More in relation to the business discussion and the modeling that I think all the investors and industry are looking for. And I'll start by saying that back in 2006 in the Ontario Economic Summit, I addressed President Bill Clinton. And in part of the discussion, he talked about First Nations and tribes owning and operating energy projects in their territories. So from there, you'll recall in Ontario, former Deputy Premier George Smitherman at the time, First Nations began immediate discussions on what would then become the Ontario Green Energy and Economy Act. Within that act, what we were able to bring forward was the Aboriginal Adder and the Aboriginal Loan Guarantee Program. There were a number of ministerial directives as well that tied the infrastructure piece into the generation world. So, you know, the generation really driving the issue and costs around the integrated power system program here in Ontario. Overall, to say this, that what was really important, you know, over the last decade has been the inclusion of the Indigenous community. And where it pertains to people on the ground, communities in the north, for example, here in Ontario, we have in the hinterland, you know, a number of communities that are on diesel. We also have a number of communities that say perhaps are not in a position where they have upgraded energy infrastructure and facilities. And I'm wondering how much thought is being given to the value in establishing criteria and benchmarks around legacy projects. I'll give you just a short example. In our community territory region, which is on the north shore of Lake Huron, there's a mining company that's looking to reestablish in rare earths. And what they're doing right now is they're looking at a solar project that would actually power up and electrify the facility there. They're in direct discussion with our community right now because as part of the legacy and the remediation of their project, it leaves an opportunity for us to benefit and gain. And it's resource revenue sharing, it's value added, and what I'm hearing a lot of the business side of this, but how much are people thinking about the Indigenous community and the business potential that exists there?
Sorry, that's an excellent question. Thank you. So yeah, I mean, maybe Richard, I'll put it to you. I mean, so if you have an IPP that comes into the room seeking financing, but it has a significant Aboriginal ownership, and there's a plan that you know, for example, that part of the offtake for the mine or the offtake for the power will be to the surrounding community, and perhaps after 10 years, it will be used to provide electrification for the community and the surrounding area. I mean, how do you look at that? And again, how is that value of the social license to operate weigh into how you view that project?
Well, you know, the question of valuing a social license is actually really that's a difficult question. And the reason it's difficult, and I'm sure Andrew and Tom can weigh in on this as well. The fact of the matter is it's kind of it's a bit of a binary thing, and then yet it's not. And at the end of the day, if any company gets to a point where it doesn't have social license to operate, before it's all said and done, it's not operating anymore. So that's kind of the downside point of view. Now, on the upside point of view, that I can see from what the gentleman, the situation you've outlined, is that, okay, let's say that the mine, the fact of the matter is, this means that, when we talked about, well, what does this do for reclamation? Well, this is an ideal reclamation situation because the fact that the power station at least stays in place. In fact, what you would actually really start doing is start looking at what facilities are actually built as part of the mine, because in many cases these are remote and locations, relatively remote, and not only does the power production facility stay in place, but also a lot of the other facilities that are not directly related to production, like the offices and stuff like that, probably can stay too, because they probably have some use to that local community. And that's something you have to sort of work with that local community of whether it be First Nations or, for that matter, somebody else. And so I think it actually is a really interesting question. Then the question is, well, how do you put an economic value on that? That's the question is, and what makes this so difficult is if you're talking about a community that has no electrification, if it has diesel electrification, then at least you can start saying, okay, well, you can start maybe trying to figure out consumption and so forth and start trying to figure that out. But if it has no electrification, that's even more difficult. I mean, I think it's, but I think it's all stuff you try to consider and you try to figure out how to value it, but it's not straightforward. It's not as easy as when we have a utility or something like that.
I can certainly say from the perspective of IFC, we don't work in Canada or the States, but certainly we do a lot of work in sub-Saharan Africa. And I think, as Richard said, it's a precondition for our financing. There has to be significant local involvement. It's part of the Equator principles that IFC established for how projects are done. So yeah, I mean, I'm working on a large wind project in Kenya now, and it has significant involvement it's in Maasai territory, and it's a precondition. But I do think that it's looking at it through the harsh lens of a financial institution. It's risk management, and even if you just look at strictly as social acceptability is a key issue that you have to. It's not to say it's a risk, but it's something you have to consider. Otherwise, the project is not viable. You can have great offtake, you can have a great sponsor, but ultimately, if there's not good acceptability of that project, then the project can be in trouble.
I was just going to add. I think it's a great question. It sort of takes us a little bit outside of our normal box of thinking. But I think if you reflect upon it and you look at not only the choice of type of generation itself, in some respects, can be has social implications. Try building a new oil refinery somewhere versus a renewables project, and you've got a completely different dynamic. I think in terms of financing institutions and how they view sort of the social policy ramifications of what they're doing, I think a lot of it gets tied into kind of larger corporate messaging. I think that Richard's bank being involved in projects throughout the Americas and in emerging markets, that itself is a social policy type of decision, and is an empowering feature of their bank. In the United States, our group works with a variety of banks, each of which do have a little bit of a different kind of social messaging. We work with Rabobank, for example, which views itself as kind of catering to the agricultural and rural communities, and they pride themselves on having a presence out in the in those remote locations. In many cases, with involvement in the United States, Native American, in tribal territories. I've done the financing on a wind project in the U.S. in Southern California with the Kumeyaay tribe there, and it did require a much greater commitment to kind of local sensitivities and cultural sensitivities, and making sure that everyone was kind of on the same page. So I think we definitely do look at that, and frankly, even on that Arizona project I was mentioning earlier that's on mining land, we had to, right before completing our financing, go back to ASARCO and get an additional 5-year option on the tail end of our lease option to sort of improve the longevity profile of the project. And in doing so, we actually encountered an extensive discussion with ASARCO because their plans for their end of life, of the mine was that they actually anticipated that 30 years from last year that the land would be used for housing. That it would probably be residential developments and the like. So we actually had a pretty extensive social policy discussion surrounding that. So I think it's looked at and reviewed sometimes as a core part of a corporate mission, but oftentimes it can be sort of behind the scenes.
All right. Well, I think we've we've run out of time. But at the start, I said that it's bringing up the bankers is always riveting. I hope you found it fascinating. I certainly did. I want to thank Andrew, Tom, and Richard for their participation in this panel. So we'll give them a big round of applause.